TGIF Warriors, Alexander, Sinatra, Hank. How you guys doing?
Dale, how are you feeling?
Hanging in? Not
Oh,
terrible symptoms. So
look
so
at you. You're a beast.
so far so far mild.
That's good to hear.
Good.
You didn't catch it off Bidden, did you?
Didn't catch what?
Didn't catch the lurgy off of Bidden, did you?
Off of Biden.
Oh
Biden.
no, I
Did
did. So both the president and I are still, although testing positive, still at our duties.
Yeah.
Okay,
Combined
so
danger 308.
yeah, so what a difference a few years makes getting it. So although my in-laws and my wife are pretty sick. So um, anyway, markets. I have to go with Ryan's call yesterday, where he really wasn't impressed when the ECB gave the market more than it was expecting, or the most it was expecting, and said, it's really not exploding here. And then the next 2-hour candle gave it back and tried to recover. At the same time, the pullback's still only 38%. So maybe next week we'll get some levels to try it and risk the low. Maybe halfway back, 61.8 back. That's what I'm thinking for next week. How about you, Ryan? I know K-Man's having internet issues, I saw. So you're the guy today. And Stell and Blake and everyone else who's
Who's a guy?
Yeah. Well, actually, you know what? I don't even see Stelios today. It's I mean, look, if you're in Greece, I mean, you're gonna have a 2-day work week anyway. You know what I mean? I mean, that's kind of that's Stelios' game there. It's Friday.
Steve taking a nice vacation too. Those guys have good summers, don't they?
They do. I tell you, it's and some of you don't know this. I like to harass Stelios and Steve quite a bit, but I got married in Greece. I married a Greek woman, and I've been to Greece a couple of times. It's by far the one of my favorite countries that I've ever traveled to. And it's gorgeous, and it's a beautiful place to be, especially in the summertime. If you're in the Cycladic Islands. And so Steve is visiting Rhodes, and I believe his part of his family lives there. So Steve spent the week over there. Yeah.
Nice. Well, it's nice to live in a place where everyone else wants to take a vacation. So you're living, I felt that way when I lived on the beach in North County. I go, why do I need to take a vacation? I'm already where I want to be.
Yeah, I mean, that's the. I was visiting my buddy in Point Loma and last week, and he's like I don't want to leave this place. I'm like, I don't blame you.
Where are you gonna go? Where are you gonna go to top it anyway?
Right.
So
well, let's get into the markets, man. So Ryan. So how do you feel about the ECB and how the euro is performing today? What Dale was talking about.
It's been a funny day, funny morning. We had the ECB hiking 50 pips, and then the PMI is going into contraction.
Across the board.
Manufacturing mainly. They were all down, but manufacturing in France, Germany, and the pan-Eurozone number went into contraction. So that's like hike 50 and here's an egg in your face. And obviously the floodgates are now open, and all the ECB bods coming out all day this morning, giving their views on it. They're all data dependent. I think that the biggest two comments from the ECB yesterday was Lagarde mentioning FX levels and how that influenced the hike to a point, and also that the prior guidance on September rate moves no longer applied. So if I take two big news items from that'll be it. It means we're going to now swing around on the data to try and guess whether whether SEP's going to be 25, 50, whatever. As far as the euro goes, bit disappointing, really, if I have to be honest. I didn't end up doing anything. I was looking at 103, 40s, 50s on the upside. parity on a downside, and we didn't even get close to the 50 fib of the move there on the other side, up at 102.83, I think it was. Couldn't even reach that. So a bit disappointing, but the market has definitely turned. I think we're going to find the euro is going to be a rally seller from now on, particularly in the aftermath of the ECB, and on the back of that poor data. But we'll see later on. We've got the ISM from the US. Sorry, not the ISM, the PMI, market PMI from the US. So we get to see, is the US still the best of a bad bunch, or is it going to start dipping as well? And I think that's going to be a deciding factor for the euro here.
And I want to mention, just so everybody's like the significance of today's data. If you look at what the forecast readings were for the PMIs, most analysts were expecting these Eurozone PMIs to come in well above 51. For most, for like German, they expect a little bit bigger dip, but a lot of the PMIs missed aggressively. It wasn't like they slipped by 0.2 points more than forecast, or 0.2 of a point. No, I mean, these misses were like pretty significant, and now most of the reads are below 50, which is now a contraction on a lot of the PMIs, especially like the manufacturing PMIs, as you're pointing out. That's ugly data. So when you see that big of a jump in the PMIs, you start to look at U.S. PMIs, which are expected, as you pointed out, Ryan, they're expected to come in around 52 and a half for the services PMI, flash manufacturing at 52. I mean, I don't think we're gonna have a sub 50 print. I would think that would be a pretty crazy print today. Yeah. But it's possible. But what else is happening though? And I think this is really important.
Yields,
yeah, well, yields are coming down.
Look at what they're threatening here, man.
Yeah, no, I agree. Yields are starting to come down. You got the dollar yen slipping. You got the dollar slipping pretty much. I don't want to say across the board, because the euro is still kind of holding around these levels. Yeah, but what I want to say is that we are now getting very close to that Fed pivot, and I know people have been wondering, like, when is that coming? We are starting to see it, and I know we talk about this, and we have been for the last 2 weeks now. We are in a good is bad and bad is good. So if we get bad data today, if the data comes in on PMIs and they come in, let's just say we slip below 51 on, services and manufacturing PMI. Let's just say, for argument's sake, we slip more than a point in those. You're going to see stocks rally on a miss. I believe.
They've been on a tear.
Huh? What's that?
They've been on a tear.
Well, yeah, stocks have been moving higher. That is correct, and they're holding gains, and even in light of some of the earnings that came out last night. I mean, you saw some of the earnings. They're all disappointing. So I don't know. I'm thinking that we gotta we might see some continued upside. I mean, you got stocks like Capital One, I think, missed. Snapchat missed. I think STX missed. So I mean,
but I think you need a bit of context with those. And I said it when we first got the first round of the banks and stuff earnings coming out. Yeah, there's misses, but the numbers are still pretty good. Okay, so say revenues was 1.9 billion instead of 2 billion, that's still good numbers. It's not like things have gone into complete reverse and revenues are down 50% or stuff like that. It's minor misses, and that that's supportive for stocks as well, because they're not seeing a whole scale collapse in earnings.
Right.
So I think it's the other side of the coin. Rather than misses being bad news, it's the size of the misses, whether the news is bad or not.
Yeah,
Go ahead. I'm sorry.
Oh no, please, Dale, go
Oh,
ahead.
just the relative strength in the Aussie is really market tell. If you want to buy anything against the dollar, look, it's threatening this wedge line right now, and
Yeah.
that's with the dollar coming off. So Aussie, your generational trade, Blake, it's starting to be like my generation.
Well, I've got a lot of longs in the Aussie dollar. I got hit on a
It looks
bid.
great. Looks
Um,
great, man.
yeah, I mean, I got hit on an overnight bid on an ad at 68.50, so almost 100 pips ago yesterday morning,
Wow.
like yesterday in
Yeah.
European trade. So like what 24,
And that's with
30,
a firm
about 30
dollar.
hours
That's
ago.
what's impressive to me. With a flat to firm dollar, it's making progress.
Yeah, I mean it look, the Aussie looks great. I want to mention here. Mike says the Fed pivot is not coming with CPI above 9%. I don't think a Fed pivot's coming like anytime soon, but the market is a future pricing mechanism. Yeah, it's discounting and it's already starting to sniff it out. Look,
Although
by the
Jim
time the
Walsh
Fed,
hates
by
that.
the time the Fed pivots, the S&P will be trading back at 4,300. Just keep that in mind. And that's
They don't
not
ring a
like going to
bell.
happen tomorrow. What?
Yeah, everyone thinks they're going to ring a bell and the market will be going down, and then the day they ring the bell, you could just do it.
Yeah, the day you start getting this like if you sit here and you wait for the Fed to start giving us a dovish commentary and pivot, if you wait for that, you're going to miss the next 200 S&P points higher. I'm just saying. That's and that's fine. Like if you guys want to, miss out on that move, that's cool. That's cool. Go ahead. It's fine. All right. So, let's go. Let's take a step back really quick, and I want to ask you this, Ryan. What else are you seeing out there that catches your eye? Because I'm going to tell you a few things that really have caught my eye today. So make sure you guys
show the charts.
Oh, I got charts to show. But
Yeah,
Ryan, what else? What else are you seeing?
Well, obviously, dollar yen is a big mover as well.
It
I think
is.
catching the yield bug as well. But CPI was up in Japan last night. In the core, it was up a point, but down in the headline, and that got a little bit of reaction there as well. So again, people come around to pushing the BOJ's buttons. Are they gonna start tightening up again? And a bit of a reaction there, I think. But yields are the main driver here. Those tens really dropped back in the US. Look at German yields today, absolutely cratering in the 10-year. But look at the data front. If we're talking about data, look at the pound. The UK PMIs, they were down on last month, but certainly not the collapse that we saw in Europe. And that's coming on top of retail sales, which are also not collapsing. Bit of a boost there from the Jubilee holiday. That may wash out, but everyone was like doom and gloom on the UK. It's going off a cliff edge, and here we are. It's not quite off the cliff edge just yet, and it might be Europe that goes that way first, and that's then impacting euro sterling. But the thing to look at, as I mentioned this morning, you look at rates. Whatever you think of rates, the ECB has gone 50. The Fed is expected to go 75 next week. That still opens up 25 pips difference in the Fed's favour, no matter whether they're all hiking. And while you've got those differentials still in play, you're going to see the dollar favoured over the euro and others, but perhaps to a lesser degree.
Well, and you think that, but how about if the Fed doesn't do 75?
Yeah, that's going to be a shock. Then you're going to see euro dollar, rally.
Are you kidding me? The euro is going to rally. We're going to see the Aussie trading at 72 cents. We'll have the S&P trading at 4,200 like really quick. So I'm gonna and there's a couple of comments that have come in, and I want to Mike was responding. He goes, Blake, I got you, but aren't bond traders jumping the gun? They might be, but yields continue to come down, and I think that's going to be, that's going to be an important factor that we're looking at. I mean, the bond market is just suggesting that we're heading into a recession next month. Next week we get U.S. GDP. That can confirm that we are in a recession as of next week. So that's something else that we got to think about. And I want to point out a couple of things that are really moving here. And Dale, I know you brought in the Aussie dollar. And just so you guys know, if you're a ForexAnalytix subscriber, we've been looking, long on the Aussie and the Kiwi for a while. So this is how we're viewing the markets. These are, patterns in play from, weeks ago.
Nice shot by Grega this week, calling the top of the yen and an ending diagonal.
Yeah, and you know what? And Grega, just so you know, he was on the short side of the Kiwi, then flipped long and already took some profits there. So Greg is he's crushing it over there. But what I wanted to say is regarding the Aussie dollar hasn't even hit, the wedge line resistance. Now the Kiwi is. So now notice where the Kiwi's at. We're at the 618 retracement. We break above 62.70 and we're going to trade back up towards 63.64 cents. But that's not what's got my attention right now. What's got my attention right now is the big breakdown in the Euro Aussie. The Euro Aussie came down to, and I know I talked about this on the trade-off show. Oh. No, I actually, this is my chart of the day, or my play of the day on the trade-off show with Pepperstone Securities.
You win a trophy or anything?
No,
right. No trophies.
No. I don't even get a pat on the back. To be honest, I just kind of continue on. What I was identifying is this big 618 retracement. It's a big fib level, and I've been playing this one to the short side quite a bit. And I mean, the price action has been bearish. When we get to a big fib like this, like we've been at for this whole week, and it's not bouncing, you got to imagine it's going to eventually break down. I mean, it's kind of like a. Imagine like a ball, right? You take a ball, and like let's say you got a table, right? This is a table, right? And you bounce a ball, and it bounces, and then it just dribbles, and then eventually falls off the table, right? Does that make sense? I don't know if that drawing actually made sense. I think what I have to do is make that a little bit bigger. So yeah, like you bounce a little rubber bouncy ball, hits a table, and it, eventually just kind of falls off the edge of the table. That's what happened here. And, so with the Euro Aussie breaking down, you got to imagine this is a risk on type of move. That's not only happening in the Euro Aussie, but you can see the Euro Kiwi has broken down. Pound Aussie has broken a triangle, and broke through horizontal support. Pound New Zealand also breaking lower. This is all reminiscent of risk on, and you can see the Dow is actually hitting highs right now. And if you go look at the S&P, the S&P is just consolidating gains. We should hit, after the false breakdown from last week, we should hit at least 161% extension of this consolidation. So what that means is with the S&P coming out of this descending wedge, we should trade to the previous lows that were back in February. It doesn't mean that the bear market's not still intact, but that could very easily mean that the S&P could rally, from the lows, 12, maybe even, 15, 18% to the top of that channel before we roll back over again, or maybe even the 200-day moving average. So, there's a lot of tailwinds right now that are helping the market. You can see where, earnings, like you pointed out, Ryan, earnings, there's some misses, some downgrades, some lower estimates now, the stock market's still holding up. You know, if we have PMI data that come out in Europe and they're horrendous like they were, stock market's still holding up. I mean, you know, you know, I mean, look at the DAX. The DAX gets it. What were German PMIs? I think German PMI. What did the data come in overnight, Ryan, at with the German P?
Both for Germany, it was bad. Both services and manufacturing was into contraction.
Oh, but yet the DAX shows a bull flag pattern.
Yes.
And it's trying to break out. Right? So, anyway.
All yield driven right now, buddy.
Yeah, I mean it's everything, right? And who actually raised rates yesterday more aggressively than had anticipated? Also, this kind of went under the radar, and thank God, K-Man, who's not here today, he's dealing with internet issues. He mentioned this to me yesterday, and I totally spaced it. But the SARB, you know, South African Reserve Bank, they raised rates aggressively, higher than expected. And we saw the U.S. dollar South African rand break down. We're hitting lows. This is another indication that stocks are pushing higher, right? So just, you know, you're watching the, you know, emerging market currencies like the rand pick up steam, dollar mex, big reversal from a 50% retracement. I guess we can probably just do that. And I mean, you know, those are the kind of things that we're looking at that just suggest, hey, you know, if you're short risk, you best be careful. So anyway, what else you got, Ryan? What else are you thinking? I mean, you know, are you a buyer of Bitcoin here? Dale, are you a buyer of Bitcoin?
Nope.
Come on.
If you do,
Come on. Why not?
If you do, you have a real hard stop at 18.5, and our next guest, Michael Singleton, has a great chart of 18.5. And you know what 18.5 was a prior high before this cycle when we went from 18.5 to 3.
You know, I don't think it was 18. Well, okay, so 18. I hear what you're saying. Isn't that?
Yeah, there it is.
Yeah, this is 19,600. Well, but that's based on the data that I've seen across the board, and I know I've mentioned that. Okay. Actually, we talked about that on that day, after like a week later, because remember I was going to our Christmas or holiday party, in New York City when I was trading for Gelos. Yeah, and I got the call from my nephew's mom.
They were retiring.
No, she's a lady that she doesn't know anything about any type of markets, and she wanted to put all of her money into crypto. And I was actually walking from they just called my number, and I was walking across a little sky bridge thing to get on the plane, and I got the call from my nephew, and I was like, we got to. You know, like no one. I'm like, don't buy any crypto from there. Yeah, and that was that high right there. But anyway, that's the number. And I think that as a result, Dale, it's really holding that breakout point.
Yeah,
that's it. I mean, that's it. I mean, you know, and this is something that we talked about again. I talked about it this week on the trade off with Chris Weston. I said, hey, look, I mean, you know, we may have overshot that 20,000 level, you know, roughly by a couple thousand points, but it's Bitcoin. I mean, when you're looking at a monthly or weekly chart, you can't say, oh, it's to the pip. You know, it's around about that area, and we held it, right? So big levels there. But so Ryan, you're not gonna buy Bitcoin here?
I wouldn't buy it with your money, mate.
Okay. All right. Well, I think we're seeing a tactical bounce in crypto, and I think they can extend. I think Bitcoin could at least see 25,000, if not 30,000. And you know, I do trade it on the futures market, so I might actually be looking to short some Bitcoin up around 30,000 if we get there. But Ethereum is definitely outperforming Bitcoin right now. So that's one thing to point out. Now we've seen a big bounce in gold and silver. So Dale, what do you think about these precious metals? I mean, we don't have Stelios here to defend himself today. So what do you think about
I think it
gold
would
here?
have been more bullish if gold had taken out that prior low and cleaned out the stops. I don't know if they did at 1680. That looks like it held that line. So I'd be happy if that was it. But the recent action and the weak RSI, we need a rally so that the next flush can show some internal relative strength. But if the yen is peaked, I think gold is bottom. But the jury's still out on both of them.
Yesterday's price action. This is it's a bullish outside day.
Yeah.
And a really key hold of the 2021 lows. I think that was February or March. Yeah, February or March, and this is August. So we held that to a T. I mean, if you're like a long-term trader, you've got to look at gold and say, okay, well, as long as it's above 1670, I'll be a buyer here. And what are you risking? 50 points to make what?
Underneath it, people are talking 1500, 1560.
Yeah, of course they are.
Numbers underneath it.
Of course they are. But if we and then another thing you should probably take a look at here is this is a AB equals CD completion. I mean, again, there's a lot of support down here. I don't
take it.
Yeah, I mean, it's like your risk, and as a trader, that's all we really care about, right? I mean, I know there's some traders out there that just don't take losses. They refuse to take losses, but those of us that are trying to protect, our accounts, we know exactly where we need to get out, and we know what money we're trying to make. And if it gets down to our level where we need to get out, we just get out. We take the loss.
We know it's a one mistake business because we've all made it.
Exactly. Because you'll eventually wipe yourself out if you're just not taking losses. You're not.
On that gold. There's a comment there from Khalid who says, wished it had flushed through 1676 and rebounded. I want to ask why people want to flush through when you've got a technical level that looks so strong. Why do you want to flush through rather than?
I'd like to answer that question because it catches everybody off guard. Because it's a false. I love false breaks. False breaks are like a lot of fun to trade because let's say we broke through this 1670 level. What's it going to do? I mean, it's going to trigger a lot of people to get on the short side, right? You're going to get first of all, you're going to get a lot of systematic selling below there. Then you're going to get a lot of predatorial type of people like you and I getting short, looking for a move down to 1600. So we're going to automatically have entry orders to sell. Then you got all these other long-term traders that are all stacked up with orders down here, and all those get triggered. And then you go everybody gets short, and then you get all the longs out, and then you get a reversal. As soon as you get back above 1690, that's when you go long. So I love playing like that. So I think
I get that.
About the positioning, Ryan.
Yeah, I get that, and I see a similar potential in the S&P. But for this one, if you wait for all that, if you wait for the break and the flash, you potentially miss out on the long off the level in the first place, don't you?
Yeah, you can.
Yes, you can. Yeah, and I agree with that. So I think there's a couple ways to trade it. First of all, it's like, dude, you play it here, and for some reason, if it doesn't work and you get stopped out. And if you really think that it's just a stop run, then you look to play it long again. You look to play it on the long side down here again. And because I do both. I do both.
Yeah.
But
we know there's many ways to skin a cat. I just wanted to pick a particular angle there because everyone will look at the technical line and think that's the line to trade off of. How do you pick that lower entry, if you know what I mean? So if it breaks, where's the bottom? Does it come in at 1640, 1630, 1620 before you get that bounce? It's hard unless you've got the text down there to back that up. Sometimes for some traders, it can be hard to define where to then put your risk and your trade on a break if you think it's going to bounce from there. But
Right.
it's just another. This is the fun in trading. So many different views on what is pretty much the same trade, trying to get long on it.
Did we just have Canadian retail sales come out just now? I think we did. Shoot, I might have missed that. I don't have any. Go ahead.
I bought some Crown Royal for my COVID. Maybe it'll show up there.
That'll cure, and I'll be the first one to admit that it does. Let's pull up the Canadian. How did the data come out?
Yeah, it came in better than expected. 2.2 versus 1.6 expected, and 0.9 in April. X Autos 1.9 versus 1.6 expected, 1.3 prior. So decent data, but it is way behind everyone else. It's major.
And remember, we're living in the upside down too. So if you guys like the Stranger Things like callback, just be careful because stronger data could actually end up reversing. That's the kind of market we're in, right? I'm not trading the dollar CAD. I don't have any Canadian positioning going on right now. But let's talk a little bit about something before Dale takes over, because I know he has his guest coming on. Which is this your first time with this guest, Dale?
Yes. Yeah.
All right. Cool. So I don't want to keep him waiting. Let me just mention this, guys. Make sure you check out ForexAnalytix. Remember, this is our show, so I will talk about ForexAnalytix. It's only $1 for 10 days to try out ForexAnalytix, so make sure you try it. Jump in our community. We probably have one of the most active trading communities out there. You can see just in our chat rooms alone, we have not only chats, discussions, threads. We have a macro chat room, and this is the trades room. And where we put in our trades, we have places where we upload research. When people get research, they upload headlines there. A lot of great things about our community and ForexAnalytix, and that's why when you're trying the trader funding program, which a lot of people have been doing. The one thing about like these assessments, when you try to prop trade, we started a prop trading firm, but to do that, we bring you in our community. So this way you have trade ideas, you have support, and you're just not out there left alone. So check out the trader funding program, check out ForexAnalytix, and with that being said, Dale, have a great interview and have a great Friday, everybody. Thanks for always being here and supporting us and being with us as the market's moving. We enjoy having you here, and without you, we don't exist. So thank you very much.
Cheers, guys. Have a good weekend, Bill.
Okay, Blake Ryan, thanks so much for the excellent content all week long, and in F.A.C.E, and a lot of coaching happens here, a lot of learning, and some great actionable ideas. So appreciate you guys. And gosh, I'm happy to introduce Michael Singleton. Michael, welcome to F.A.C.E. Looking forward to us having a discussion. This is Michael's first time here on the F.A.C.E show, and waiting to hear from you, buddy.
Dale, thank you for having me. It's a pleasure.
Great to have you, Michael. So, are you going to be sharing the screen today, showing any charts or anything like that, or do you want me to move around the board?
If you don't mind helping me out there, that would be terrific.
Okay. All right. So I'll be sharing my screen. Michael, I went to your video that you recommended I take a look at before we went to our interview today, but I'm always interested in how people end up doing what they're doing. So was it in college that you knew you were interested in the financial markets and reading the tea leaves of the economy? And what were you doing before you got in the industry, and what was your first gig in the industry?
Sure. So it probably does start in college. I was I originally came into Notre Dame in the School of Arts and Letters, so more liberal artsy. And Notre Dame's a big football school, and I'd go to the football games, and one of the first things that I did was start trying to sell cigars to tailgaters at the football games. And by the hour, that was probably my best job ever. And so I quickly figured that I wanted to study business instead of arts and letters. So I went on to study finance. I got really lucky. I ended up getting an internship at T. Rowe Price as a sophomore in college. So that was terrific exposure to the markets, and I was sort of lucky to get a good name on my pedigree. And I was, able to leverage that into some other roles on the buy side. I worked at a private equity firm the following year, and after college, I ended up at a hedge fund called Broad Run Investment Management. Again, really lucky to have such a good experience. I got the chance to sort of spearhead my own investment opportunities. I got the chance to, sort of travel the street, go to conferences, meet some really smart people. And what I observed as an analyst there was that, Wall Street is full of really, really smart people, maybe some of them are even geniuses. I don't know. And so what I noticed was a lot of times when they would get stuff wrong, especially on the stock level. So I worked for an equity fund. They weren't getting things wrong because they were stupid, or they weren't getting things wrong because they didn't know their stock well enough, especially on the buy side, right? Sell side has sort of its own conflicts of interest. But on the buy side, when people would get stuff wrong, it wasn't because they were dumb. It wasn't because they didn't know the underlying asset well enough. What I noticed was that it was usually because they were missing the forest for the trees, so to speak. They were missing the bigger picture. They were missing the business cycle. And if you look at back tests and different studies on the impact that the business cycle has on the pricing of individual equities, the business cycle really accounts for about 55 to 80% of the price action in equities. And so if you're ignoring the business cycle, if you're ignoring the growth cycle, the inflation cycle, the policy cycle, you're missing out on an enormous reason that stocks move, right? And so you're going to be confused a lot. And a lot of times people don't think about the business cycle until the wind is at their face, right? They'll think because they're investing in software stocks during a period of loose monetary policy or easy monetary policy that they're just really great stock analysts. And they don't stop to think about the macro environment until all of a sudden policy tightens and their stocks are 70% off of their highs in 6 months.
So here we are, and
here we are.
here we are, and you make the point that fundamentals do matter, and if you couldn't count on the fundamentals mattering, it'd be very difficult to have any sense of what asset class you should be considering taking some risk in. So let's get to the fundamentals. So I know that you believe that we have a deflationary impulse happening right now that is slowing everything down. What do you think the Fed is going to do next week, Michael?
That's a good question. And to be honest, to maybe take a step back, I think we're transitioning from a stagflationary environment into a deflationary environment. And I would say that in both of those regimes, growth is slowing. The difference is obviously that in the deflationary regime, inflation is slowing as well. Now, that doesn't mean negative inflation. I don't think anyone with a brain is expecting negative inflation, in the next few months. But it means something below 9.1% next month and below that the following month. In terms of the impact on policy, I think that, my time horizon tends to be a little bit longer than most of the people on this call. We're usually looking at months and quarters. So if your time horizon is months and quarters, then the impact of policy is not so much in the front months. It's not so much usually about whether the Fed.
There's a lag between what the Fed does and it filtering through the economy, isn't there?
Absolutely. The impact of policy on the real economy happens on a lag, but the bond market, which is how a lot of policy is transmitted, tends to be forward-looking, right? So, obviously on the 9.1% CPI print, you're way above expectations. A lot of people's first reaction would be, all right, tighter policy. And you saw the front of the curve, the front of the Treasury curve move up, but you saw the back of the Treasury curve move down. And why would that happen? Because the bond market knows that the Fed is not going to be able to raise rates forever. And
look at the 10-year right here, Michael. I think this level is very important. It's 272, 274. hard to get long bonds. I'll use the TLT as a proxy going into the Fed, but they've been acting pretty good. And you're talking about how the interest rate cycle is very important, in that yields are really, the yields and the dollar are really are the main drivers of what's happening to get this deflationary impulse wave, whether it's just a correction in commodities, which I think it has, because if you go back to the 70s, even Volcker thought he had it beat and then had to come back in and really get draconian. And I think in the 70s, there were several times that it looked like inflation was peaking, and then it reemerged. Could this just be one of those times and just be a commodity correction?
So I'm admittedly sort of a secular disinflationist. I think that over the long term, a lot of the drivers of disinflation that we've seen since 1980 remain intact. And with the exception of maybe globalization, right? I think you could make the case that in a multipolar world, where our supply chains are sort of a national security concern, that globalization has to come in a bit. But when you think about demographics, when you think about debt levels, when you think about wealth stratification, when you think about the ease of credit for anyone that's not a public issuer, all of these things still shout disinflation to me. And if you look at the bond market, right, if you look at 5-year expectations, 10-year expectations, 5-year forwards, they're all saying that we remain in a disinflationary regime. And so, in my view, the fundamental evidence points that way. The market appears to be agreeing with me, at least for now. So I don't think that this is a 1979 situation. Right. Okay. Yeah, exactly. I don't think that there needs to be a Volcker moment. And I don't think the bond market,
no Volcker.
Right. Well, and the bond market is also saying that there's no, if you look at Eurodollar futures, if you look at Fed funds futures, if you look at short-term measures of Treasury curvature, they're all saying that the Fed probably has to cut pretty soon. And the only way that that makes sense is recession, right? There's no chance that the Fed is cutting rates with 7, 8, 9% inflation over the coming months unless there's a recession.
Okay. And you're talking about, I believe we're going to have a GDP print pretty soon. And to you, it's not just the number, it's a rate of change of GDP. So can you explain that to our viewers?
Right. So if you go back and do the back test, markets generally trade on the year-over-year rate of change most closely. It's a more accurate reflection of the business cycle. I'll say that the headline number that everyone talks about, and I'm sure that this is widely known on this podcast, is a quarter-over-quarter seasonally adjusted annual rate. And there is a ton of accounting noise in how that number is calculated. And so if you run back tests on that quarter-over-quarter number, they're very, very noisy and not terribly helpful. So my suggestion is anyone looking at GDP data is to look at the year-over-year rate of change. And my other suggestion might be, don't spend as much time looking at the GDP data. There are better measures of growth out there. We're big fans of the manufacturing PMIs at Invictus. Find those are more accurate, higher frequency measures of growth with a much closer relationship with tradable assets.
Okay, and on some of the charts that you showed, 103 was a very big area for you for the dollar. Do you see anything on the horizon, perhaps the dollar losing its interest rate edge with what's happening here, for there to be? What could possibly cause a peak in the dollar fundamentally?
So according to our work at Invictus, the dollar, and you could say most currencies, really trade on two things: interest rate differentials and policy, right, and then also risk appetite. So what could cause the dollar to go down? I think there's two reasons. One is rates in the US go down, or two, global growth starts to reaccelerate again. I think the latter is very unlikely for right now. I think the bull case for the dollar right now, in our view, is that other central banks become more hawkish relative to the Fed. But we think the most likely outcome is that global growth continues to decelerate quickly. And so there's a flight to safety into the dollar. and so we expect the trending performance of the dollar to be higher. I mean, that's not to say that it can't, dip to 103 again or something like that. But over the next 3 to 6 months, our outlook is still bullish.
Okay. Do you think that with what's happening, especially in the end, it's really been a parabolic move with the weakness in the end. Is it possible that there could be some kind of central bank intervention to stop it? I know that Paul has said he wants a strong dollar, but is it possible that the rest of the world doesn't, and there's something like a Plaza Accord deal in the works here for Japan, because Japan couldn't do it on its own? They would need the Fed, and Europeans couldn't do it on their own either. They tightened more than expected yesterday and had a pretty poor response to the 50 basis point hike. Yeah.
So
does that go ahead?
I mean, I'll caveat my answer by saying that Invictus is more U.S. focused, and you're probably
Okay.
more knowledgeable on this than I am. I will say that I think the U.S. Federal Reserve wants a stronger dollar. That's part of how they tighten financial conditions. I think that they're more than happy to export inflation, and I think that right now Japan is more than happy to import inflation. They'd rather import inflation than tighten policy. Their economy is just so anemic for a variety of reasons. Very weak credit system, terrible demographics. That devaluing the yen is not as big a deal for them as it might be for other markets. It's just, hopefully America isn't Japan in 20 years, although I'm kind of biased that way.
Okay.
But yeah, that's our view. I'm inclined to think no intervention will be taking place.
Okay, and I want to go to your take on stocks, because I know that you're, mainly in defensives, right? So I just want to show this chart that, an acquaintance, a friend of mine on Twitter sent to me, and it's the spread between the high risk Russell, low quality, compared to, mega caps. And the spread looks like it could be possibly turning. Is that something? I know that's not something you're expecting. If that happened, what's that saying? If small caps begin to outperform the spider?
So, by our investment framework, there are really 3 macro variables that drive pretty much all liquid asset classes, as well as the different factor exposures and style sectors in the equity market. It's growth, it's inflation, and it's monetary policy, or rather it's the expectations about those things. So the macro variable with the closest relationship to small caps versus large caps is growth. When growth is accelerating, small caps virtually always outperform large caps. And when growth is decelerating, large caps almost always outperform small caps. And so if you were to see the Russell break out relative to the S&P, that would be one piece of evidence that the stock market is discounting faster growth ahead, accelerating growth ahead. I can tell you from, all of the work that we do, all of the bottom-up work that we do, all of the market analysis that we do, we don't expect growth to accelerate again anytime soon. So our expectation is that this sort of consolidation, range trading in the ratio of the Russell to the S&P probably resolves downward, or best case sort of remains range bound. But we don't really expect a breakout. That said, we know what a breakout means if it does happen, right? That would be one bullish piece of evidence.
Okay, yeah, and like technicians, you probably want confluence of economic indicators along with what's happening in the markets to change your
Right,
view.
and just
You need more
what
than
makes
one
logical.
reason.
Right. And just what makes logical sense in terms of historical business cycles, right? You wouldn't expect that when the euro dollar curve is inverting, that small caps would then outperform. That would be highly inconsistent with historical business cycles.
Okay, and I know you talked about copper, copper being Dr. Copper. You showed most of the economically sensitive commodities under more pressure than things like agricultural commodities. And you made a comment about gold that you're warm to the idea of owning gold, but you just don't see a tactical level that makes sense. Does that mean that you can't find a level where your profit, your risk reward makes sense because you know where you're wrong? When you go into something, what's your risk management on, for example, a position? If you took it in gold, do you use stops, or how do you find that tactical place? And we all have to manage risks no matter what our ideas are. How do you do it, Michael?
So on gold, I think if you're going to have a view on gold, you really have to have a view on real rates. So going back to 2003, I think the relationship between real rates and gold is very close. The R squared is 0.82. The correlation is, I think, 91%. So
Okay.
unless you're just a pure technician, I think you have to have a view on real rates. What
Okay.
drives real rates? Expectations for real growth and policy. And right now, our expectation is that real growth continues to slow. And to be honest, our expectation is that policy, as quantified by the 10-year real rate, probably goes down, right? It becomes easier on the margin. And so that means our outlook for gold is bullish. We'd rather be looking for points to buy rather than points to sell. I think when the video that you saw, it was trading at maybe 1800, and it was just sort of in the middle of a range.
Okay.
So the upside was maybe to 2000, but the downside was to 1700. It's just not an asymmetric setup. We would want to be buying as close to a reasonable support level as possible. Whether we're buying right on support or whether we're buying a failed breakdown. Our outlook is a little bit longer term. So if we have to sacrifice $10 or $15 on the trade because it's not perfect, or it breaks down and it breaks out again, we're less concerned with that.
Anything in the bond market? Yeah, and anything in the bond market that you like here? Sovereigns or anything. It looks like they, both the market and bonds bottomed right around the beginning of the summer, around the solstice. And I wouldn't be short bonds right here. What do you think with your outlook for a weakening GDP, and you talk about the Richmond PMI and all the other PMIs that line up? Most of your charts in that video show the actual moves heading down, and then you extrapolate from that, and they all looked pretty weak and getting weaker. So why not a position in bonds besides a defensive equity portfolio?
I think you got to be long bonds. I think as long as long rates are below their 2018 highs, I think bonds are a very asymmetric bet, particularly relative to equities. When the Fed isn't tightening and growth is slowing, bonds are really the best way to go. So we like bonds a lot here.
Yeah, why can't, even if it's a bear market rally, right, Michael? I mean, halfway back, that's a nice capital gain, but who knows? I know some people that don't think that we've ended that 30, 40-year bull market. Any other area in the market that you want to talk to us, either economically or asset price wise?
Oh boy. So did you see the Philadelphia Federal Reserve survey yesterday for manufacturing?
No.
That was quite a bearish report in my view. And I'm inclined to think it's bearish for the same reason that some people might think that it's bullish. So the two numbers that I thought were most interesting were prices paid and prices received. And we saw really substantial downticks in both of those. And so I think that, and if you go back and do some back tests or correlations, both of those time series tend to correlate pretty closely with CPI inflation or PCE inflation. So the surface level interpretation is that inflationary pressures are easing and supply chains are normalizing. But I think if you think about it a little bit more deeply, I think that's partly true. I think supply chains are normalizing, but I think second order thinking tells you that when you see really quick down moves in pricing like that, it's usually a reflection of demand destruction. And that's exactly what the Fed is looking for, right? And in combination with everything else we're seeing, we're inclined to think that there is a significant element of demand destruction in those declines in price. So anyway, I thought that was interesting and worth calling out.
Are we in a recession, Michael?
I think it's hard to say that we're in a recession while the economy is still adding jobs, technically. I think we're in a growth contraction. I think that, monetary policy happens on a lag. And so I think it's extremely possible we see a recession and that we see a rather rapid increase in unemployment over the next 3 to 6 months. But I don't think it's, formally in a recession yet.
Okay. Well, you know what's in an expansion? My guest list with having a guy like you on to share your knowledge with our community. And I really appreciate your time, and I respect your research and what you've been saying and your demeanor. Best way for people to follow you and follow up on this, should they have an interest, seeing you live or the video. Uh, Here you go. Here's some free deals. You could go to invictusresearch.com. Is that the website?
Right. It's invictus-research.com. And then I'm also on Twitter at Invictus Macro.
Well, Mike, I'm so glad Tom recommended you to me. It was a great recommendation. You have a unique blend of, being an economist, but having a feel and flow for the markets as well. It's usually one or the other. So you have a great blend of both fundamental, and I saw your charts. I want to leave it with the great chart that I saw yesterday was in the crypto. You even covered Bitcoin, and you were talking about how this 18.5 level in Bitcoin is so key because it's it's a prior high from another cycle, and that would end up being like a breakdown to you if we took these levels out. And you showed that Ethereum already did it. Does this week's action, last couple of weeks action, change the picture in Ethereum? Is it back above that level?
I think it's helpful, before you start taking real economic signal from it, it's helpful to sort of give it some time to settle.
Okay.
I think if it's below that level, that's very bearish for, the underlying assets and also crypto as an asset class. But if you zoom out and it doesn't break below that level, these are still two of the most bullish charts you can find over the last 10 or 12 years, right? So I don't want to jump the gun.
You believe in the asset class long term?
I think the technicals are telling you to believe in the asset class long term. I mean, not the technicals over the last 6 months, but over the last 5 or 10 years. I do think that there are underlying economic problems that crypto is trying to resolve, namely tight financial conditions for people that aren't public issuers, right? So everyone always talks about how easy financial conditions have been since the great financial crisis.
Yeah.
And that's kind of true if you can issue public debt or maybe public equity. But if you are running a small business or you're poor, you better believe financial conditions are really tight. If you go through the small business, I can't remember the name of the act, but you can go through some government filings to see how much commercial banks have been lending to small businesses. It peaked in 2008, and it didn't get past that 2008 peak until the middle of COVID in 2020. And that was because the government was backstopping all of these small business loans. So banks have been incredibly resistant to lend to small businesses since the great financial crisis. Yeah. And the result of that is that good ideas aren't getting funded the way that they used to. And so a lot of the different DeFi projects right now are ways of more efficiently allocating credit. And do I think that's something that the US economy and probably the world needs? Yes. Does that say anything about any specific project or about the near-term price action of Bitcoin or Ethereum? No, it's more of a thematic view. But that's where I see the value.
Okay. Mike, you survived an interview with me. You know what that makes you?
No, what does it make me?
My trading warrior brother.
Oh, I'm honored. Thank you for having me, Dale.
Accept it? Okay, well, I had a good time interviewing you, and would love to have you back. Appreciate your giving spirit to share your knowledge. I know it wasn't easy to get proficient like you are nowadays. Took a lot of hard work, right, buddy?
Yes, but there's nothing more interesting than the markets.
Okay, so everyone, Michael Singleton, figuring out the biggest jigsaw puzzle in the world and combining fundamental analysis with also being actionable on asset classes. Thank you, Mike, so much for being with us today. Have a great weekend, a great summer trading season, and let's talk again in the fall.
My pleasure. Thank you for having me, Dale.
Okay. So that's a wrap, everybody. Hope everyone has a great weekend. Remember, don't just count your economic indicators, count your blessings. You could join the team in 15 minutes on the Morning Edge, and I'll see you Monday. I'm determined that the show must go on, COVID or not. You're welcome, guys. All right, President Biden and we're going to work all weekend and make our plans. All right, have a good weekend. Adios. Thanks again, Michael.
Yeah, thank you for